Our next section is a workshop. This is an expert workshop, and it's on transforming organizations with blockchain technology. Our speaker and expert trainer is someone who's been here with us at ConnectGov several times before in his previous role as well. Previously the CIO and COO at MyRepublic Singapore. This morning he comes to you as the senior advisor and the expert trainer for CIO Academy. Please welcome Eugene Yeo.
Thanks, Joe. All right, good morning, everyone. All right, it's Friday, right? We're very close to the weekend, and I'm sure in your minds you're thinking about what we're going to do over the weekend, right? Whether to go cycling or whether to do something exciting, right? So I'm going to try to keep this workshop as interactive as possible, as interesting as possible. Again, the topic is about blockchain, so it's something that I'm very passionate about. So a quick, introduction on my journey in blockchain. I started my own Bitcoin mining site, I think sometime in 2009. So that was the beginning of my experience with blockchain. Currently, I run several validator nodes on some of these public blockchains, and also do development on blockchain as well. So I'm very passionate about the subject. But I have a first question to ask, people in the audience. And when we talk about blockchain, what do you think about? What's the first thing that comes to your mind? Anyone? You can shout out. Cryptocurrency, all right, cryptocurrency. Anything else? NFTs, right? You heard about some of the NFTs, the crazy prices that people are paying for these NFTs, right? So there's some of these buzzwords about cryptocurrencies and the prices of Bitcoin and Ethereum Bitcoin hitting 64,000 recently, Ethereum hitting 4,000 odd, right? But there's a lot of underlying technology in blockchain that we can actually apply to our organizations to do transformation and help us in that whole transformation journey, right? And in this 15 minutes that I have with you, I'm going to split it into two parts. The first part is about setting in that foundation for you to understand a bit more about not just blockchain, but also some of the underlying concepts in blockchain and cryptocurrency. And once we understand those foundations, then we can go on to understanding a bit about the trends that's happening in this whole blockchain cryptocurrency space. So the topic of my talk today is really on foundations and trends in blockchain technology. All right, so quick overview of the agenda. We're going to go through the basics of blockchain, try to help understand a bit more about how it works. Not too technical, I'll keep it as understandable as possible for the layman. We'll talk a bit about smart contracts. So smart contracts is something some of you have heard about, but not everyone. And it's a very important concept in understanding how we can actually build distributed apps. Now, the third thing is tokenomics. And whole cryptocurrency space is driven by this concept of tokenomics, which is really token economics. So in this segment, I'm going to talk a bit about why it's important and how we can use tokenomics to help you perhaps in your transformation as well. Then we're going to talk about three trends. The first trend is decentralized finance. Second trend is non-fungible tokens. And the last trend is Web 3.0. And we'll do a quick summary at the end. So are you all ready? Let's go. So basics of blockchain. Before I talk about the basics of blockchain, I want to talk a bit about this analogy. Imagine you're on an island. This is an island that has a lot of coconut trees. And there's villages. Each family basically plants coconut trees and harvests the coconuts. So they needed a way to keep track of how many coconuts each family has. So let's say at the start, family 1 had 100 coconuts, family 2 had 85 coconuts, and family 3 had 115 coconuts, right? And as the families add coconuts, they'll start to write it into this book. We call it a ledger, right? It's a journal of entry. So family 1 added 3 coconuts, but family 2 removed 4 coconuts because they needed to buy some chickens from another family, right? So family 1 traded with family 3 with 5 coconuts for 2 liters of milk. Now that's all well and dandy because these families 1, 2, and 3 trust each other. Right, they've been living together for many, many decades, so they trust each other. But what happens when a new family comes in, say family 4? Right, it's a new family, and they were given 20 coconuts to begin with on this island, but they wanted to buy a herd of cattle, right? So before the transaction happened, the family, let's say family 1 was selling them the herd of cattle, and they wanted to check in the ledger how many coconuts did family 4 have. And suddenly they see this entry that family 4 suddenly had 500 coconuts. So what's the problem here? The problem is that the system is now broken, right? There is no more trust. You can't trust this ledger. And that's really the foundations of blockchain. All right, so what are the properties of blockchain? And I'm sure most of you have heard about it. The first property is the fact that it's very secure, right? All records are individually encrypted. Second, it's highly distributed. We call it a distributed ledger technology. Thirdly, it's anonymous. And fourthly, it's immutable. Now, the word immutable basically means that we can't go back in the past, change a record, and expect everyone to believe it. And blockchain has a system to prevent fraud from happening because it's an immutable chain. So let's look a bit deeper about what that means, right? Every blockchain starts with what we call the genesis block, right? And the genesis block could have a bunch of data. Let's say the data says good day. It has a previous hash of 0000 because it's the first block, and it has a hash. Now this hash is a one-way hash that basically is generated from what data you have. And every time you change the data, the hash will change. Now this is a very important concept in blockchain because it's the foundation of immutability. Remember, the moment you change the data, the hash changes, and this is part of cryptography. So block 2, the next block in this chain, it will have the new data on block 2, but it also have the previous hash of the first block, the genesis block in this case, and you have its own hash. And this is exactly how you chain the blocks together, by having the next block have a copy of the previous hash from the previous block. So imagine, as you chain these blocks, you're going to start to have this chain of hashes. And if I go in back to the genesis block, and instead of having good day there, I say good night, that hash is going to change. But when I go and look at block 2, I'll see that the previous hash does not match with the initial hash that I have now in the genesis block, and therefore that chain is broken. So this is how blockchain works fundamentally, by linking hashes of the previous hash to each other and chaining the hash together. So why is there a need for decentralization? I mean, if we looked over the years, over the decades, for example, in the banking industry, there's been many cases of fraud, many cases of perhaps human error in the way transactions are happening. It costs millions or billions of dollars when these things happen. And that's really the problem of the centralized model, because you have one authority or a few people in a group that can make the decision to transact a particular deal, right? And if these people collude together, you can actually have fraud, or maybe perhaps they all make mistakes, and then you have human error. Which is why blockchain is so interesting, because blockchain talks about decentralized model, where in order to build trust, you have many, many, many parties involved in this decentralized model, right? And that's a very important concept. Every one of these parties hold that ledger, like from that coconut plantation, the village, all of them hold that ledger. So if family 4 decides to change something, they have to get everyone to agree to the change. And if everyone doesn't agree to the change, then that change will not be valid. Now we're going to talk a bit more about consensus models. What are consensus models? Consensus models are basically how you come to agreement. How do you agree that a new block and the data is accurate, is valid, right? That's really how we create that trust. And in blockchain, there's two very broad ways of creating consensus. One is called the proof of work, and one is called the proof of stake. And proof of work is something that a lot of people are familiar with, because when you look at Bitcoin, you talk about mining, right? You talk about the need to run a lot of big GPU rigs, right? Graphic processing to find the right hash key in order to validate the work. And that's basically proof of work. But the problem with proof of work is that it's very environmentally unfriendly. And that's a big challenge, right? Which is why there is a new concept called proof of stake, where proof of stake means that I own a bunch of perhaps Ethereum coins, right? And I stake my Ethereum coins to say that what you're telling me is true or not, which means I will validate the transaction. And if enough people validate the transaction becomes real, becomes validated. And it's easier because you don't need a lot of processing power in order to do proof of stake. So let's look at the journey a bit. Again, like what I said, in proof of work, miners will mine capacity depending on computational power, but in proof of stake, you are really validating based on how much you own in that network, right? In proof of work, miners will receive block rewards. So every time they mine successfully a hash, they will get a bunch of rewards. They'll get Bitcoin back. And that's how they're incentivized to continue mining. But validators do not receive block rewards, right? When I do proof of stake, they collect transaction fees as rewards. Right, and most importantly, in order to hack a proof of work, hackers will need to control enough compute resources to be able to hijack that proof of work and validate a particular block. For proof of stake, you need to own at least 51% of all the cryptocurrency in that network. And for the bigger public chains, it's really very difficult to do that. You're talking about hundreds of millions, if not billions of dollars in order to drive that. So let's look at a process flow about how we put all these concepts together in a blockchain transaction, right? First of all, you start with a transaction being requested. Let's say I want to transfer 10 Bitcoin over to my friend to buy a Lamborghini, right? So I'm going to make that transaction. I'll start it by saying I'm going to send 10 Bitcoin over. And this transaction is going to go into a block. It's going to go into a queue. So imagine like you're at the train station and there's trains coming, right? So every train is a block. So I'm waiting for my transaction to get on board the train and go. So there is a mining period, but there's also a time where my block will be mined. And if there's a lot of people in that platform waiting for the train, then it really depends on how much I'm willing to pay for it, right? So anyway, a block representing the transaction is created, and the block is sent to every node for validation, every participant for validation, right? The nodes validate the transaction, and the nodes receive a reward for proof of work, right? Typically in the same cryptocurrency that we're trading, for example, Bitcoin. The block is added to the existing blockchain, and is distributed across the entire network, which means that every node now has the latest updated transactions, right? And finally, the transaction is complete. So that really shows you that process cycle of how a transaction starts to how it's being mined, distributed across the entire network, and therefore creating trust and immutability. Now, just one quick question. Do you know where's the furthest blockchain node that is ever deployed in the world today? Anyone has any guesses? It's actually an Ethereum node that's been deployed. But it's not deployed on Earth. In fact, it's deployed in space. So they just successfully deployed it in last month in September by SpaceX, and SpaceX deployed an Ethereum node in the International Space Center. So imagine that. Even if you, as a hacker, you try to take over all the nodes on Earth, it's not enough. You have to go to the International Space Center in order to take over that node there as well, in order to validate your transaction. Right, and that's the power of distribution. Now, the next concept that we're going to talk about is smart contracts. So blockchain aside, now we have a basic understanding of what a blockchain is, how it works, how it drives immutability and trust. But we're going to bring it one step further into this concept called smart contracts. So what are smart contracts? Smart contracts are basically self-executing business automation applications that run on a decentralized network like a blockchain. Right? The most popular smart contract platform is the one that I just mentioned, which is Ethereum. Right? And there are several things that the smart contract platform needs to allow. The first thing that it has to allow is codification of business logic. And now it gets very interesting. Imagine you can actually have a business process, codify that business process, and automate that business process on a blockchain. And that's what smart contracts allow. Secondly, it allows the verification of the business logic that you have codified and ensure that only verified transactions are allowed and approved automatically. And finally, it's always about execution of that business logic as well. I'll give you an everyday example of smart contracts that, for decades we have been interacting with, right? Look at this. This is a vending machine. And vending machine is a great example of an everyday smart contract. Why? Because I put in money, I select the snack that I want, and the snack is dispensed, right? And this whole logic is codified within that vending machine, and I'll only get the snack if two things happen. I put the right amount of money, and I select the snack I want, right? So this is a great example of how smart contracts work. But instead of the vending machine example, it's actually working on a blockchain. So what are the advantages of smart contracts? Well, the first thing is you can imagine speed and efficiency, right? Because you don't really have a human processing that process for you. You have robots doing it, you have the system doing it. So it's really rapid, it's really fast, it can be done within seconds. Secondly, you've got trust and transparency. Why? Because there is no man in the middle to manage the transaction. You know that you can trust the system end to end. There's no way of man in the middle tampering. Third thing, again, security. Back to the fact that there's no middleman to actually tamper with anything. But lastly, it's cost savings because the whole process is automated, right? Instead of having someone sitting down there and saying, yes, this transaction is valid, now you have codified and automated the entire process on the chain. Now, I want to talk about one more concept, and this is going to get a bit more deeper into technology. We're talking about the importance of data and oracles. Right, so what are oracles? When you hear the concept of oracles in blockchain, they are basically data feeds. Because in order for smart contracts to work, I need to get data. And this data may not reside within the chain itself, but it could be residing elsewhere. It could be residing on IoT devices. It could be residing on other chains and transactions that's happening on other chains. So oracles are what we built to do that integration of data feeds, to bring data within the chain or out of the chain in order for these smart contracts to expand into practical and real-world use cases. And that's very important. And the reason why I wanted to talk about this is because I want you to understand that concept of oracles. Right? And what sort of oracles are there? There are software, hardware oracles, there is inbound data oracles, there's outbound data oracles, and there's consensus-based oracles. But the most important takeaway from this slide is that smart contracts cannot exist by themselves. They typically need data feed in and out in order to make it more usable, right, in real world. Now, when we talk about smart contract platforms, there's really a lot. And if you look at the top 5 cryptocurrencies, typically you'll see the first one being Bitcoin, but the other 4 below would likely be smart contract platforms. Some of these, the number 2 in the world would be Ethereum. Right, that's the most popular, and Ethereum was the first smart contract platform on blockchain, so that's why it's the most popular. You've got EOS, you've got Cardano, you've got N-Chain as well, and you need to understand there's a difference. If you look at the bottom, right, there's a difference between public chains and private chains. So why is there this difference, right? So what's a public chain? Public chain is something that is permissionless. That means anyone can come in, access the chain. If I want to put a contract on Ethereum today, I can. I just need to pay gas fees. If I want to run an Ethereum node today, I can. I can just launch it and run it, right, by following that open source code. So it's permissionless, it's public. But that's the big challenge for a lot of enterprises and organizations, right? Because a lot of data you don't want to be public, right? It could be confidential data, but yet you want to leverage on blockchain to help you, create an immutable, traceable record. So that's why the introduction of private chains come into play. And private chains, of course, are permission, meaning to say that you need to have permission to be able to access the private chain. It's actually typically faster and more cost-effective. In public chains, you pay a high price in locking each of your transactions into that block, but in the private chain, you don't. So it's cheaper, probably lesser latency. But then the question is, why do I need a private chain? Right? Why can't I just perhaps run horizontally scaled databases across all my edge, right? And keep all the data everywhere? Well, going back to the foundations of blockchain, right? One of the great use cases of private chains is to keep audit trails in your organization, so that one person, a bad actor, can't go in and change that audit trail. I mean, if you all watch the very popular Korean series Squid Game, I'm sure some of you have, you understand that, there's this portion where the people actually modifying the video, right, as they were trying to do organ harvesting, right? So they actually had an internal guy who was changing the video feeds. Now imagine if you commit each video feed into your private chain and commit that hash in so that you can verify whether that video feed is accurate, is authentic or not. That could possibly be a use case for your organization. And private chains work perfectly for that. Right, the third concept that I want to introduce today is tokenomics, right? And tokenomics is a very, very important concept in terms of how you can actually use blockchain and build cryptocurrency, right? And this is basically the underlying factors of price volatility, of all the different dynamics when you do an ICO, right? When you list a public token. So tokenomics stems from the words token and economics. And it's a study of the economics of a crypto token, right? From its functionality to how you're actually allocating the token out to people. And in order to know more about tokenomics, it's important to know the various types of tokens. So when you look at the cryptocurrency world, you always think about Bitcoin. And when you think about Bitcoin, you think about Bitcoin as a store of value. They always compare Bitcoin to gold, the new gold, the digital gold, right? But there are actually a lot of other tokens out there. For example, in Ethereum's case, when you buy Ether, which is the token that Ethereum sells on the exchanges, you're actually buying a utility token, right? You're basically buying Ethereum that you need to use, right, in order to do certain smart contract transactions, right? So you have security tokens, you have utility tokens. You've also got fungible tokens and non-fungible tokens, right? Non-fungible tokens are tokens that exist as one, right? In your NFT space, right? It's unique, it's only one. Fungible tokens means you can create a lot of the same thing, right? You've got layer 1 and layer 2 tokens. And this is a bit more technical, right? I won't go too much about it, but the problem we have with layer 1 solutions or smart contract solutions like Ethereum is the fact that gas fees are very high, the transaction cost is very high. So they actually built a layer 2 solution on top to accelerate, the mining or the locking of data into a block, committing of data into a block, as well as reducing the transaction fees as well. But more importantly, we need to understand this concept of tokenomic factors. And these are the factors that affect your price of your token and the volatility of your token. Right, the first thing whenever you think about launching a new token is the fact that you have to think about how you're going to distribute it and how you're going to allocate the token. Right, that's very important. Right? Who are your initial people who receive this token? Secondly, supply of token. If you look at Bitcoin's case, the reason why Bitcoin has hit 60,000 is people always talk about the fact that it's very rare. There's only 21 million Bitcoin that's ever going to be produced, right, in this lifespan of Bitcoin. So there's scarcity built in. And supply of token with scarcity means that your price is likely going to elevate if there's a lot of demand. Market capitalization is important, right? If you look at the whole crypto space, you've got the high cap coins like Bitcoin and Ethereum, and then you've got low cap coins, which are the new public coins that are being introduced. You talk about the token model as well. And token model is something very interesting. Why? Because you've got inflationary models where the amount of tokens that you have continuously grow and grow and grow, and there is no cap to the limit of tokens. But you also got deflationary models, or you got fixed models. In Bitcoin's case, it's fixed. In Ethereum's case, they actually launched this new protocol update called EIP 1559. And the whole point of EIP 1559 is to burn Ethereum as it's being used in smart contracts. And sooner or later, if the number of transactions that's happening on Ethereum increases to a certain level, it becomes deflationary. So there's actually an impact on price. And finally, price stability is important. And as I go into the section on DeFi, you start to understand why sometimes we prefer stable tokens versus very volatile tokens. And there's use cases for those tokens as well. But why do we want to understand tokenomic factors in an enterprise, right? It's very important to understand this because tokenomics is actually one of the ways that perhaps it could help you, do more with your ecosystem. For example, if you're running a gaming ecosystem, you would run your own token model that allows people to trade artifacts using your own currency. Right? That could be one way. You could use tokenomics to drive NFT, drive rarity, and drive value of certain items or artifacts that you have. You could also use tokenomics to perhaps raise working capital. Right? That could be one of the ways. As you partition different phases of perhaps a fishery, right? In different phases of the fish, going all the way to your table, right? And maybe driving investments in each of these phases. So there are many ways you can look at it, but it's a very important concept is in this whole blockchain and crypto space, right? So I'm going to take a pause here. I'm going to ask a question again. I'm not sure whether you can have a mic to be passed around. But looking at all this, what are some of the use cases that you can think of in your mind as you think about blockchain now?
Yeah.
Anyone?
Yeah, it's Ashish. So I just wanted to know in what situation we are using ERC 721, and then what situation we are using ERC 1155.
Yeah, so the ERC is basically protocol, right? And the protocol is the protocol that the token will be integrated with in the chain. So ERC20 would be the typical protocol, the Ethereum protocol that you use. But there are other protocols on other chains that are not Ethereum. So it really depends on which public blockchain you are going to be using. For example, to transfer your tokens, right? And that's a very important note because if you use the wrong protocol, you may lose your money. But that's really on the crypto side. Yep. But anyway, back to use cases.
Thank you, Eugene.
Yeah, you got it? Okay, back to use cases. If you think about it, blockchain really has many use cases. And in like Derek's presentation, he has given you quite a few. For example, traceability, creating trust and trustable. And there are a lot of other such use cases where blockchain can come into play. But in the next 3 trends, I'm going to talk about things that's ballooning in this whole blockchain space and how it can be relevant to the way that you transform or run your organizations, right? So the first trend is called DeFi. How many people have heard of DeFi? Okay, half of the audience here has heard of DeFi. So DeFi basically means decentralized finance, right? And it's the crypto equivalent of, or is the blockchain equivalent of your entire banking finance industry, right? So before we talk about the whole ecosystem, we talk about what the draw of digital currencies is. And there are a lot of factors here. I'm not going to go through these factors. I'm sure you can take a read. But the key focus here is the fact that cryptocurrency is very portable, right? It's different from cash. Right? If you watch the Marcos Netflix series, you realize that one of the big challenges these drug lords have is that they have to keep stashes of money inside their cupboards, dig it underground. And the problem with keeping money underground is that the rats will go and eat it, right? So it's very difficult to bring and carry this cash around. But with the advent of things like Bitcoin, it's very different. Right? I don't need to keep cash. Everything is virtual. I can transfer my Bitcoin from one country to another almost instantaneously without anyone knowing because it's anonymous as well. Right, so that's the big draw of digital currencies. The other thing that we need to understand beyond digital currencies is that there's this whole concept of stable coins. So remember, we talked about price volatility in tokenomics. And the whole point of stable coins is to prevent price volatility. And there's a very, very important use of stable coins. Because the last thing we want is we want to transfer our money into Bitcoin and realize that Bitcoin crashed from 60,000 to 30,000, therefore losing your portfolio in one day. I think that's not something that you want. So it's not a very good store of money unless you expect the price of Bitcoin to appreciate, right, over the next few weeks or months. So that's why there's this introduction of stable coins. And stable coins, to make it stable, there's always a one-to-one peg. At least that's what they say. Right? So a stable coin, for example, USDT, which is Tether or USDC, every coin that's minted will have a $1 US dollar that is, tied to it, right? Of course, there's a lot of talk about whether Tether has the US dollar equivalent as they mint more coins. But what are the advantages? Well, the advantages is really, it maintains the benefits of crypto coins, which means that you've got the immutability, you've got the trust, you've got the anonymity, you also got the speed of transaction, but we can peg it to any asset, and that's the good thing, right? You've got stable coins for Singapore dollars as well. Someone launched it recently in Singapore, right? But the most important point is the fact that you reduce volatility, right? Because once you reduce volatility, there's actually a lot of benefits that digital currencies can bring, right? Because now I know that my $1 US dollar that I put in crypto will not be 50 cents tomorrow. Now, we also need to understand that stable coins have some sort of volatility there, but it's much lesser than the more volatile coins like Bitcoin. For example, if you typically see market crashes in crypto, you start to see prices of USDT go down to maybe 89, 90 cents, right? But very quickly, it'll move back up to $1. So you can still see it's still rather stable. Most important point of stable coins, it enables us to do cross-border transactions. Right, and that's very important in business. Actually, a lot of times, as we do cross-border payments, 2 biggest problems come into play. The first thing is speed, right? It takes days for transactions to happen. Second thing is cost, right? Because you have a lot of middlemen to do that. But by using crypto, by using blockchain, and by using stable coins, you can actually enable a much more robust and trustworthy system where the value that you're trying to transact won't change from an hour-to-hour basis. So what about digital currencies by governments? I mean, we also hear a lot about these. There's this thing called the central bank digital currency, right? They are digital in nature, but the very important point to note is that they are not decentralized. So remember I talked about smart contracts and there being public chains and private chains. Well, digital currencies from central banks are considered like private chains, where it's, in order to participate, you have to be given permission and it's controlled by a central authority. But there's value to these digital currencies as well, right? And the value to the governments Well, of course, number one, maintain control of monetary policy, right? So they can still manage supply and demand of your money. The important point for governments now is that they have full traceability of the currency because they can see for a particular coin, where has it moved, whose wallet has it moved, and whether there's any money laundering activities or whether a business is trying to avoid tax or not. So that's that benefit. Again, enhance AML protection. Right, so I see the trend moving forward that digital currencies are really going to be more and more adopted by governments. And you look at the Chinese government; they're already pushing digital yuan. Singapore is also toying with digital Singapore dollars. So a lot of governments are starting to try to push this. But in order for digital currencies to take effect, you need to have a digital payment ecosystem, right? And that's very important to note. So I think China is really way ahead in that game right now. Now, we go back to the main topic, which is areas of DeFi protocols, right? The whole decentralized finance field. And look at this chart. It's really amazing. Over the last 5 years, you saw a huge boom, right, in innovation that's happening in the whole decentralized finance sector. So you got protocols that takes care of payments, protocols that takes care of decentralized exchanges. For example, if I want to change my Bitcoin to Ethereum, I can go through a decentralized exchange rather than through Binance or Kraken or one of the centralized exchange. You've got stable coins, you've got compliance, you've got wallets, right? You've got marketplaces. The ecosystem is becoming very, very vibrant. And a lot of innovation is happening here. And this is something that as leaders of companies, we cannot ignore. Because where there's innovation, there's opportunity, right? And there's growth. So we take a quick look at the growth in numbers, right? And you look at the DeFi market cap, you can really see that in 2020, it really spiked, right? This is the total market cap of DeFi coins. And it's been very stable, 2018, 2019, but in 2020, it started to boom. And you can understand what was one of the main factors, right? Main factors would have probably been COVID, right? They really drove a lot of digitalization and a lot of adoption of cryptocurrency as well. And if you want to look more into DeFi, you can look at several of these popular projects. I participate in Compound. I love Compound, really because it allows me to lend my money, not deposit my money in a standard bank, but lend it on a DeFi lending platform where I get a much higher interest rate, right? So that's a very interesting way of making better interest. Interest on Compound, depending on the coins, you can even reach up to 10% per annum. Right, you've got Uniswap, which is a decentralized exchange, and you've got Argent, which is a decentralized wallet that allows you to keep your tokens secure. So, looking at this trend, what are some of the things we should be expecting moving forward, right? We expect to see continued growth in this whole DeFi industries with projects that will simplify and harmonize the way that we bank, right, with the decentralized way of tomorrow. So some of the areas I feel is going to rapidly increase. And this is where perhaps companies can start to look at participating. Is of course cross-border payments and remittances. You've got lending and loans. You've got exchanges, inflation protection. And in fact, I put a reserve.org there. It's a very interesting white paper, if you have time. It's reserve.org. But it talks about how they are trying to create a stable coin. There's inflation protection involved as well. And if you come from Argentina, you understand that having protection against inflation is very important because you don't want your $1 that you have earned today to become 1 cent tomorrow, right? Areas of asset and portfolio management, it's great areas. Derivatives and futures is growing, and escrow services as well, particularly in smart contracts, because you can actually codify when to release certain amounts when certain conditions are met, and that's escrow service. But talking about benefits and growth, we also need to look at potential risks in this market, right? And there's several risks that DeFi and the whole crypto has. First of all, governmental and regulatory risks. Like recently, you had China saying that no one's allowed to use cryptocurrency. That's a big risk by itself. Of course, I heard that they're still going to allow NFTs, right? So there's an area for potential innovation. Hacks and exploits, right? Continuously this happens because a lot of these public chains, cryptocurrencies, they are built on open source. And when it's open source, people can look at what vulnerabilities there are and try to find ways to exploit it. Market manipulation is probably the biggest risk right now. And that's the cause of how cryptocurrency is so volatile. Because unlike the standard exchanges like SGX or NASDAQ that we have, there is really no governance in cryptocurrency. There is no control authority to prevent manipulation. So trust me, there are a lot of people manipulating the markets, and that creates volatility. Right? And when they manipulate the markets, right, you get forced liquidations, especially when you have all your stop losses put. You've got rug pulls as well. Rug pulls basically means that people launch a new token, an ICO, for example, but there's nothing behind this token. People just buy into it, and suddenly it disappears. Right, so that's really the whole DeFi space. It's very exciting, and there's a lot of further research that needs to go into it to see how it can be relevant to your organization's needs. But now we want to move on to the next trend, which is non-fungible tokens. And this is a bit on the lighter side, right? So what are NFTs? NFT, again, non-fungible token, can be represented with assets like art, collectibles, real estate, right? And the key features of NFTs is the fact that it's unique and non-interchangeable. One NFT is not the same as the other NFT. And that's very important because that allows it to have a certain price point. Very scarcity because there's only one of its kind. It cannot be broken down into subparts. Right? You can't break this NFT into part A, part B, part C. It doesn't work that way. And they are quite valuable. So this is one example of Every Days, the first 5,000 days by Beeple. It was sold in 2021 for $69 million US. Can you imagine paying $69 million US for this piece of art? And to be honest, you can actually just copy and paste this, right? And put it as a desktop image, right? But someone paid $69 million, and the person is actually a Singaporean, if I'm not wrong. They paid $69 million for this, right? To have the ability to claim that he owns the original. So some of the other famous NFTs, I love this one. This is the Nyan Cat. This was built in 2011, sold for $590,000 US. Jack, Twitter, right? His first tweet on Twitter, just setting up my Twitter, it's 2.9 million US that was sold, right? And this is Punk 6965, right? Sold for 1.5 million, and currently the offering price is 7 million to buy this over from the current owner. So as you can see, it's really a craze now, right? There's a lot of hype on NFTs. There's a lot of demand, and people are willing to pay the top dollars for it. But what gives NFT value? And again, back to this, price, quantity, supply curve. Right? The reason why NFTs have so much value is because there's only one of it. There's only one 500 days. Right? Even though you can copy and paste it and put it into 10 computers and say, I got 10 versions of that 500 days by Beeple, but using the NFT technology, I can verify whether you're the actual owner or not. And that's the most important point. Right? Originality, authenticity. And that's what gives NFT value. Right? And it's really depending on this supply and demand curve. So what's the trends moving forward for NFT? Well, again, continued exponential growth. It's really growing like crazy. Every other week I see new NFT projects coming. But it's going to become more into focused areas that helps protect and encourage innovation. For example, artists create art on a daily basis. NFT would be a great way of protecting the artist's rights by protecting that art. Music as well, videos as well. A lot of these different, creativity pieces can actually be minted on the NFT, and the rights of the author can be protected. So other growth areas will also include, like I mentioned previously, gaming industry. You've got digital arts and museums. And one of the interesting projects they're looking at is about helping bridge the NFT world with the physical art. So for example, you have a physical art that's being sold in an art gallery. You can actually stick an NFC sticker that is tamper-proof, and you can convert this digital physical art, into an NFT, mint it, and when people buy the NFT, you can ship the physical art to them. So there's that bridge of virtual and physical. Rare collectibles is another big space, and real estate. In fact, in Hong Kong recently, they used NFTs to basically break down a parcel of land and sell each part as ownership of that real physical land, right? Warner Music is going into NFTs. And the beautiful thing about NFTs is that you have that integration back into DeFi. So it becomes this big ecosystem where, you have transact in DeFi, you invest in DeFi, and you can also invest in art in the NFT space using decentralized finance as well, right? And the other cool thing that's happening now is like Instagram or Twitter, the creators are actually creating this thing called creator coins. So you can actually own the creator on an NFT. So there's a lot of ideas of how NFT can help contribute to creating more value in perhaps some of the industries or ecosystems that you currently manage. But again, with every trend and every growth opportunity, we have to talk a bit about potential risks as well. First risk is data hosting and storage. So even though you mint the NFT, you still need to store the NFT, the actual image, for example, 500 days somewhere, right? And you need to find a secure place to store it. You've also got the whole issue of royalties. For example, imagine if I go up and mint Jack Dorsey's first tweet. So is that the original NFT, or is the one from Jack Dorsey the original NFT, right? So there's a lot of royalty conversations that still needs to be had, and data protection laws coming in as well. Right, so there's still a lot of challenges in this NFT space, but over time you start to see the value of creating a vibrant ecosystem, a digital ecosystem where you can actually verify the owner of an authentic piece of art. Now, the third trend is something that I'm really passionate about, and it's something that is going to affect us on a daily basis, and this is Web 3.0. So what is Web 3.0? Well, there really isn't a standard term about Web 3.0. Dr. Tim Berners-Lee, he's actually the inventor of the World Wide Web, and he was the one who coined the term the Web 3.0. And in this term that he coined, there are several key features that he talked about. First thing is that it has to be open, built on open source. Second thing, it has to be trustless. Third thing, permissionless. And most importantly, anyone can participate and no one can control. So what's the challenge with today's internet? I mean, you look at Facebook. Facebook is a huge social media platform. We contribute articles, posts on a daily basis, content, video. But the problem is we don't know how Facebook is using our data. And there's so many instances now that our data has been compromised in one way or another. People are manipulating us through using the data to know us more intimately. So these are all the challenges with Web 2.0. And with Web 3.0, it's about removing these intermediaries, companies like Facebook, and moving to decentralized social media platforms, decentralized browsers, right? Places where you actually know how they're using your data. For example, I use Brave. I'm not sure how many people use Brave browser here. Right, okay, a few, that's good. So for those who are interested in making some money and not letting Google make all your money, maybe you want to look at downloading Brave. So Brave is a very interesting browser. It's built on Chrome, so it exactly mimics Chrome browser. But the first thing it does is it blocks all ads away. So you don't see those irritating ads. You don't see companies tracking you when you're looking for bananas or something, right? And showing all the banana photos, right, in the ads. The second most important thing in Brave browser is the fact that it actually allows you to earn money, right? Because it pays you when you view ads. It pays you when you see things that are relevant to you. So you can actually earn Brave coins and you can convert that back into cash. So that's really interesting. And you start to see more and more adoption happening in platforms and decentralized platforms like this, right? That will affect us in our daily lives, right? So I never knew the power of Brave. A lot of people are talking to me for years, and only, I think 3 months ago, I started adopting Brave browser, and I never looked back. So I suggest you go and take a look. But there are a lot of other of these Web 3.0 decentralized options now available, whether it's from your browser, whether it's from storage, social networks, messaging, etc., right? And it's very interesting to see how it's continually evolving. But I want to talk about one case study that's very dear to me. It's dear to me because I was from the telecommunications industry. I ran a telecommunications group across this region. And internet peering is one of the biggest challenges in telecommunications, right? It's the biggest challenges in ensuring that when you want to download a file from the US or in Europe, you want to browse a web page from the US or in Europe, it makes sure that you can have access to that content in the fastest possible manner. And I love this project, Syntropy. Syntropy is about changing the way that internet peering happens. If you understand internet peering, today how it works is it uses this protocol called BGP, which is the Border Gateway Protocol. And the problem with BGP is it just looks at the shortest distance. So for example, if I want to get data from Singapore, in Singapore from New York, for example, in the US, the shortest distance will be going through the Pacific route, right? Through the submarine cables through the Pacific route. But what if some of these subsea cables were cut and there was massive congestion and latency in that route? The problem with BGP is that it won't route you through the Atlantic, which will have been lower latency. It will continue to push all the traffic through the Pacific, and that causes congestion. right? And that's a big problem with the current BGP protocol. It's a protocol that was invented in the 1970s and it has not changed since. And the thing about Syntropy, it's basically using blockchain, it's using tokenomics to incentivize people to create nodes, to create routing peers, to allow smart routing to happen. So instead of following the BGP protocol and taking the shortest number of hops, it allows you to understand latency to get to the point where you want, and it passes your data through the lowest latency route, right? It's a complex diagram here, but the key thing is it will find the best route for you to route your data packets. Of course, at a cost and an incentive to the routing nodes that are running this, right? And how do they incentivize these routing nodes? Through tokenomics, through issuing a token that creates rewards every time someone routes data through you. Right, and this is an interesting diagram because they actually launched this and there were about 5,000 nodes that was launched in the world. And you see all the green color ones, the darker green ones means a very, very high latency gain from using NOAA platform or the Syntropy platform. And then basically all the green ones are latency gains. Right? As you can see, it's quite effective, right? With just 5,000 nodes across the world. And you're talking about, latency gains of perhaps 100 milliseconds or more. Right? It works with existing Web 2.0 infrastructure, improve internet routing, but the key thing is latency gains. So what are the use cases for things like this? Well, if you think about gaming, right, that's a big use case there. Because in games, latency, matters to you, whether you win or you lose, right? So of course, you want the best latency to that game server. But also its ability to work out new infrastructure mediums, right? Even using Starlink satellites. They did a test recently with Starlink satellites to see whether by leveraging on the satellite paths, can you find faster latency than going through subsea cables. So we quickly talk about the trend of Web 3.0, where we again expect continued growth in this space. And the growth areas, I think, will really be on file storage in data centers as you start to decentralize where you store your data. Data transmission, for example, in Syntropy, processing and computing, distributed computing, perhaps even leveraging on everyone's compute power that you have that's idle on your computer and participating in that. Just like how Brave browser rewards you for browsing ads, right? You could be rewarded for maybe using idle capacity to help process something that has demand for that compute power. User interfaces would change, and that's a very important note. Social media as well, right? And I think the trend of moving away from Facebook to other decentralized means will start to gain traction. And over time, I think that will be the eventuality of what's going to happen. Video streaming, and a lot of other of these areas, right? Quickly talk about potential risks, right? Government intervention, again, jurisdiction, a lot of these governance issues, targeted malicious activities in the form of hacking, and of course, the loss of your private key. So back to the Brave browser. The key challenge with the Brave browser is that if you lose the private key to your wallet, you lose all your coins. And this is the same for anything to do with cryptocurrency. So the control of your wallet key is so important. So finally, to summarize this session, right, I want to talk a bit about the key takeaways. Now, blockchain, including the use of smart contracts and tokenomics, can provide transformational advantages to your organization, whether from a product or from an operational perspective. And when used effectively, it can really allow your organization to build that defensible competitive advantages in the market, whether it's from your internal process flows, whether it's from transacting with your partners, with your ecosystem, or whether it's building innovation on your products and services to give you that competitive edge. And here are some ways, in summary, that how you can actually leverage on blockchain with business transformation. Right, blockchain can become that standard for your digital transactions to really speed up that whole transaction process that you have. It can accelerate business processes. Again, using smart contracts in the example of your vending machine, it can actually help you reduce the time and cost to transact certain processes. It's very effective in supply chain management. It's an architecture based for connectivity in the sense of Syntropy. Fuel for finance, leveraging on the whole DeFi ecosystem and the open protocols to help you drive better banking services, better cross-border transactions, earning better interest rates, right? But finally, driving product value. And there are a lot of conversations to be had about how you can leverage on blockchain as the technology to enhance the competitive value of your products as well. So with that, I hope you had a brief understanding of the different parts that make up blockchain, make up smart contracts, and make up tokenomics, and also understand a bit more about the trends that's happening in DeFi and NFT and Web 3.0. And perhaps some of these takeaways can help you in charting that direction for your organizational digital transformation. Thank you so much.
So thank you very much, Eugene. I'm going to have you remain on stage. We're going to throw 5 minutes on the clock for some questions. So there's some microphones for each of the zones. There's a microphone. Someone will hold the mic for you. If you have a question that you'd like to ask Eugene, we've put 4.5 minutes more on the clock for this session. Anybody? Well, Eugene has been such an effective teacher and trainer that nobody has any questions left.
Information overload.
Okay, let's get a microphone over there. You can just give us a moment. And again, with the protocol is the handler. Well, I was going to say the handler will handle the microphone, but he's broken protocol. There you go.
Hi, morning.
Morning.
Very interesting. I see that there are many different ways to make money now. First question, how much have you made so far?
He's not charging for this talk.
Second question, can you please tell me how to make more money?
No financial advice from me for this session, but we can have a chat after this. Any other questions?
Okay, well, I tell you what, if not, what we'll do is we'll prep for the next session, which I think sees you on stage anyway. So you can take your place as the moderator for the next session.
All right.
And a big round of applause, please, once again for Eugene. Thank you very much.